lot of people come up with a process. So you pick the snowball method, you pick the avalanche method, or how about you have been sitting there letting your loans get paid off because you signed for auto debit and you kind of set it and you forget it. You're making your monthly payments, you're not getting calls from collectors, life is going on, everything's great, and you're comfortable with the amount that you're paying for your loan because you built it into your budget. You've accepted it as a charge. I think that's a mistake. I don't think it's a mistake that you're paying your loans on time. Let's be clear about that. But I think it's a mistake for you not to reevaluate your loan repayment situation at least one time per year. At least. I would even recommend looking at it quarterly, looking at it twice a year, or making sure you look at it anytime you expect to receive an extra lump sum of money. Every time you get a raise, make your student loan payments a little bit more starting from that point on. Change it. Make a commitment to increase the amount you're paying towards your student loan. If you expect to get a bonus, before you get the bonus, even if you know what it is, but some people don't know what their bonuses are until they get it, commit yourself to applying 20%, 5%, 50%, whatever you want to do. Some of the student loan debts out there for people are relatively high. And the amount that they're paying every month, even though they're comfortable with it, can be a burden, and you kind of want to get through it, don't you? So I would just recommend that sort of approach. So we've gone through what it means to set goals, to accelerate your repayment, strategies to do that, and to make sure you are checking in on your loans and you don't use the set it and forget it method with student loan repayment. The last piece of this puzzle, I know there's so many pieces to the puzzle when it comes to this world, but that's just kind of the way it is. If you're looking to quickly pay off your student loans and you have loans with higher interest rates, and I mean rates that are no longer competitive with today's market, you might want to consider finding a way to lower the interest rate. When it comes to federal student loans, you got a loan that most likely has a fixed interest rate that's set by Congress. So there was no ability for you to negotiate it. There was no ability for you to qualify for that loan with your credit to get a better interest rate. It's just the interest rate on that loan. A lot of people ask me, can I consolidate it? Well, if you're consolidating it into the federal student loan program, the answer is yes, you can consolidate, but your interest rate on your federal consolidation loan is not going to be based on your credit or necessarily be competitive in today's market. The way an interest rate is determined for a federal direct loan consolidation loan is by figuring out the weighted average of all the loans you're consolidating together. This program also generally requires you to consolidate at least 2 loans or more together. So it's the weighted average rounded up to the nearest 1/8%. Because variable interest rates haven't been a thing with federal student loans for over a decade now, chances are your student loan interest rate on the consolidation loan is not going to be much different. And because it was a weighted average, it'll reflect that. So there are definitely some calculators out there that you can run and figure out what your weighted average interest rate will be. We'll put a link in the comments to explain how a weighted average rounded up to the nearest 1/8% is calculated, so you can very easily do that and figure out what your new interest rate would be. That might not do it. You might have to look into a private student loan refinance. With the private student loan refinance, you do have to find a private student loan refinance lender. You want to compare the terms and see what's out there, see what's available. But if you've got strong credit, you have proof of income and a good debt to income ratio, you could qualify for this. What a private student loan refinance does is it lets you qualify for a new loan with your credit. It'll give you a competitive interest rate for that, and it'll pay off another loan. So that new loan could have a lower interest rate, which a lower interest rate on a loan could lead to more efficiency in your repayment journey. This doesn't always make sense for everyone because private student loan refinance will require you to have good credit, proof of income. Generally, that means a few years of employment, and a good debt to income ratio. If you don't qualify or you're having trouble qualifying for the rates you want, you do have the option to apply with a cosigner as well. With private student loan refinance, you can actually refinance federal and private student loans together to help streamline some of your repayment, especially if you're working towards efficiency in that sense. So if you're looking for efficient repayment and you're looking for a way to lower that interest rate to help you get there, private student loan refinance is one of those things that can help you. Once again, my name's Elaine Rubin, and do not forget to subscribe to the Edvisors YouTube page. I'll see you guys next time. Thanks.